Over the past several days, we've seen rising geopolitical tensions involving Iran, and naturally, many people are asking what this might mean for markets, for their investments, and for the overall US economy. When geopolitical conflicts occur, especially in the Middle East, financial markets often react quickly. Typically, the first reaction is emotional, and only later becomes rational. It is important to understand that volatility does not automatically mean long-term damage. Throughout history, markets have navigated wars, political crises, and global conflicts. Yet over time, the US economy has continued to grow. The goal of this message is not to create alarm, but to provide context. In moments like this, clarity is more valuable than headlines. Preparation is more powerful than prediction, and discipline matters more than emotion. Historically, energy markets tend to react first. When tensions rise in oil-producing regions, supply concerns can push oil prices higher. When oil rises, gasoline prices follow, transportation costs increase, and that can eventually influence inflation. However, energy spikes are often temporary, unless there is prolonged disruption to supply. It is also important to remember that the United States today is far more energy independent than it was decades ago, which provides additional resilience. Many people also begin talking about gold during times of uncertainty. Gold has historically been viewed as a safe haven asset when fear rises. Investors sometimes move toward gold as a store of value during periods of instability, but it is important to remember that gold does not produce income. It pays no dividends and generates no interest. Gold can serve as a hedge within a diversified portfolio, depending on someone's risk tolerance. But concentration in gold alone is not a long-term retirement strategy. Gold is a tool, not a complete plan. Another important factor during global uncertainty is the US dollar. Historically, when geopolitical tension increases, global capital often flows into the US dollar and US Treasury bonds because they are viewed as stable. The dollar remains the world's primary reserve currency. A stronger dollar can increase purchasing power for Americans and may help moderate inflation pressures. But it can also create challenges for companies that sell products overseas. Many investors also ask about cryptocurrency during times like these. Cryptocurrency tends to behave more like a risk asset rather than a traditional safe haven. During periods when investors seek stability and liquidity, crypto markets can experience significant volatility. Digital assets may present opportunity, but they should always be approached with careful risk management. Stock markets themselves often react quickly during geopolitical events. History shows that markets sometimes decline initially as investors process uncertainty. But over time, markets have historically recovered from geopolitical shocks. Volatility is not permanent loss. What often causes long-term damage is emotional decision-making during periods of uncertainty. So what should investors focus on during moments like this? First, avoid emotional reactions. Second, review diversification. Third, evaluate your income strategy, particularly if you are retired or approaching retirement. Fourth, maintain adequate liquidity so that you are not forced to sell investments during periods of volatility. And finally, stress test your financial plan. Ask yourself a simple question. If markets declined 15 or 20%, would my plan still function? Preparation reduces fear. A well-designed financial strategy assumes that geopolitical events will occur. They always have, and they always will.